Hello, welcome back to another video on accounting. Today we're going to talk about, in this video, we're going to talk about accounts receivable, non-current or fixed assets, and current liabilities. We'll start off with accounts receivable. You know that accounts receivable is when we bill out for property or, for products or services that we haven't been paid for cash, we've granted credit. And we talked about that in a previous video where, when we were talking about inventory, that sometimes we get credit on our payables, we are granted credit, and sometimes we grant credit in the form of a receivable. So we're going to focus a little bit more on how we account for receivables. Not so much when we sell something, because that's easy. We sell a product, we credit revenue, and we debit accounts receivable. When we get paid for that bill, then we debit cash and credit receivable for the amount. This, we're going to talk about how do we account for the fact that not everybody pays their bills. It's a reality. I know we hate to think about it, but the reality is there are some people and some companies that don't pay on time or don't pay at all. And how do we account for the fact that 100% of our receivables is not going to be collected? We can't, when we grant credit, we are always under the assumption, or the assumption that everyone we grant credit to is going to pay their bill. And if everybody did, we wouldn't have any collection agencies. So, and in my career, I spent over 20 years at an organization, and that's part of what my job was to collect money. Most of what I did was grant credit, and it was a process of understanding the 5 C's, which I'll go over later, of credit, and balancing each one of these criteria and the pros and cons of each individual company based on my analysis of these qualifications and of the 5 C's. Now, I will admit to you and all of anybody that I could not have anticipated necessarily every time that we had a good customer that why they wouldn't have paid. There are many reasons. But the point is that you cannot, in good conscience, tell investors, tell the government on your financial statements that 100% of your receivables are collectible. So what we do is we have 2 ways of handling it. There's the direct method of how we handle an account going bad in the accounts receivable subledger, or that's called the direct, and we have the indirect method, which we call the AFDA, for doubtful accounts, allowance for doubtful accounts. And at the end of each year, we create or fund the AFDA for the anticipation of bad debts in the future, in the coming year. And we use that account, the AFDA, to reduce uncollectible or reduce the receivable for those uncollectible accounts. In the direct method, which is not used anymore, we would use a bad debt expense. And we would, if we were to write off an account, we would be constantly hitting the bad debt throughout the year. With the AFDA, we do not touch bad debt but once. We create the AFDA as a large expense at the end of the year by debiting bad debt and crediting the AFDA. It is another one of those contra accounts. AFDA is a contra account to accounts receivable. So, how do we work that out? Well, the JE is very simple. In the direct method, under the direct method, if there is an account, say John Smith Incorporated owes $400 and is unable to pay it. He has said, I'm not going to be able to pay it. In fact, I'm going out of business and I'm not paying you. So when John Smith Incorporated says that, and we've exhausted all methods to collect. He said, no, I'm not paying. I can't pay. I have no money, and I'm gone out of business. So we could try to sue and spend tons and tons and thousands of dollars on suit for $400. What the easiest thing that we can do, it hurts us more than it hurts you, but we will do this. We will, on the date of that notice, we debit bad debt. It's an expense, and we credit accounts receivable for the $400. And that's the bad debt expense write-off. In the indirect or AFDA method, which stands for allowance for doubtful accounts, what we do instead is we debit AFDA and credit the accounts receivable for the $400 of John Smith Inc.'s write-off. But in order to do this, we must have some funds in the AFDA. How do we determine how much we're going to write off as bad debt? I want to introduce this, but then I immediately forget it. So it's gone. Poof! Gone. Disappeared. So there are three methods that we can use to determine how much we're going to use to create the AFDA. There are two methods that we can use. There is the income statement method and the balance sheet method. This is also called percent of sales. Is another name for it. The two methods that we use for estimating our credit risk or uncollectible amounts, or the amount that we need to set up for the following year of AFDA, is based on history, whether it's personal corporate history, or it's the experience you've had in the industry, or it's the industry standard. It's a variety of sources for this, but for this chapter, we're not looking at the source of the information. You'll be given that percentage or the method. So in the income summary or income statement method, it's the percent of credit sales. So it's whatever is the credit, not all sales and not all revenue, just the credit sales. So you need to know what the breakdown is. What percentage of revenue is credit sales, or the exact amount. So in my example here, our credit sales is $1 million. And of that $1 million, $200,000 is currently owed by customers in the accounts receivable. Our uncollectible amount is, historically we've found that about 1% of our credit sales are not collected. That's pretty good, by the way, especially if your credit sales alone is $1 million. This is pretty good. Again, I mentioned I worked for a company for over 20 years, and when I started, we had less than 1% credit risk. And so our uncollectible, but over time, as I was there, we started expanding our customer base to more riskier businesses and riskier customers. And as we increased to more riskier customers, our credit losses and our uncollectible percentage went up. So it went up to about 1.5%. So it increased over time to 1.5%, almost 2%, by the time I left that organization. So how do we figure out how much we are going to need to project? What we're projecting is next year's AFDA. Well, it's simply take the 1% times your credit sales. This, what's owed by customers, doesn't mean anything. It means nothing. So it's just 1% of $1 million, which means our AFDA needs to be $10,000. But how we do that is the amount is $10,000, but we actually do that through a bad debt expense, debit of 10,000, and we credit the AFDA for 10,000, and it's usually done at the end of the year. And that would be your transaction, the JE for this transaction. The other method we have is the balance sheet method. Now, I'm sorry, it says BS. This is not BS. This is balance sheet. In the balance sheet method, we actually, and I think that's a better method, with the income statement method or the percent of sales, credit sales, you're taking a broader stroke on it. With the balance sheet method, it's a little more accurate. The income summary statement method is an arbitrary look at what has been historically recorded in the books or on any document or any journal of the industry and what the industry says. So it's a third party or an arbitrary number more. With the balance sheet method, we look more at the probability that these particular accounts in these particular buckets are going to go. And these buckets are when the accounts are up to 30 days past due, up to 60 days, or more than 60 days past due. This method actually takes in consideration the experience of those who are actually collecting the money. It's the accounts receivable manager, the collections manager, finance manager, those type of people in the treasury side that are really looking at it versus and analyzes this information and knows the probability a lot more. You're getting into the trenches. You get the information directly from the people that are collecting the money. So in this bucket, as I call it, aging buckets, not I, but that's the name for it, is an aging bucket. Those customers that are current are current. But if they're 30 days past due, up to 30 days past due, then there's a probability of 2% of those people will not pay. Of the amount there will not be paid. If they're more than 30 but less than 60 days past due, about 3% of those people will not pay. And if they're more than 60 days past due, about 5% of those people or that amount will not be paid. So in this column right here, what I've done is I've written out what are the amounts in those buckets. Very similar, the accounts receivable is $200,000. This is the details of the accounts receivable showing that up to 30 days past due, that means current to 30 days, is $80,000. 31 to 60 days past due is $90,000, and the amounts that are greater than 60 days, there's $30,000. This equals $200,000, which is what I mentioned earlier. So how do we figure out how much is the allowable amount or predicted probability of amounts that will not be paid? We take the probability times the amount that is in that bucket. And 2% times 80,000 is 1,600. 3% times 90 is 2,700. 5% of 30 is 1,500, which gives us a total of 5,800. You see that this would be what we would use as our bad debt for the following year. And that would be bad debt expense in the AFDA for 5,800. You notice that it is a more conservative number. It's smaller, or a more liberal number, I should say, being that it's a smaller number. But I feel that it's a little more accurate because it takes in consideration the experience of the organization, of the people in the organization that is doing the actual collection. And they know how probable these buckets are through their own experience versus an accountant or some third-party analyst who's saying, Generally speaking, in our industry, it's 1%. So that's what we're going to use is 1%. The accuracy is a little bit more better, a little better in the balance sheet. Now, what if we don't have as much bad debt as we projected, whether it's 5,800 or 10,000? What do we do then? Well, let me show you. So let us pretend that in 2018 we set up the AFDA with a $10,000 balance. So we did the bad debt, we debited bad debt at the end of 2018, and we credited AFDA to start off 2019. In 2019, we only wrote off $6,000 in debt, in bad debt. So we wrote off against the AFDA. So we debited the AFDA and credited accounts receivable for a total of $6,000. And we then changed, and we used using one of the two methods, we determined that our bad debt for 2020 is 5,800, the numbers we just talked about. What is the transaction at the end of 2019 for the from bad debt to AFDA? Let me write down what I just said. I said that in 2018 we had 10,000 in the AFDA. And during the year of 2019, we wrote off $6,000 of bad debt. So now we determined that for 2020, we need a bad debt reserve, which is also the AFDA, of 5,800. How do we do that? Well, first we got to determine what's left over in the bad debt AFDA account. Now, you go through the GL. I'm going to shortcut the GL right now, but we could look at the balance of the GL. I don't have the GL and all the transactions up here, but we can see that what is the balance, what's left over in the GL is $4,000. And we need 58 to be in there. So that's a net difference of 1,800 more that we need to put in. So we're going to do now in 2020, so this would be 2019, so December 31st, 19, we're going to do a bad debt debit and an AFDA credit of 1,800. That's all we need to make up the difference. What if, though, instead of 6,000, we wrote off 4,000? That gives us a net balance in our AFDA of $6,000. And we projected that we only need 5,800 to go forward to 2020. What do? Well, unfortunately, we now have too much in our AFDA. We don't need that much because we're projecting that. Just because we have more than what we projected doesn't mean that we need to leave it alone. We can't leave it alone. We have to follow through with the procedure. And the procedures are always doing it the same way. And we did it to get the 58, whichever method we used. The point is we have too much, so we need to reduce that. So on 12/31 of 19, we have to do a debit to the AFDA and credit bad debt expense for $200. And what that's going to do is it's going to reduce the AFDA down to the 5,800 we want. what if we wrote off an account and something happens afterwards? Let's try. Let me take you through this scenario. So we have a company called customer by the name of Mario Brothers Plumbing. And Mario and Luigi came to us and said, we're so sorry. We know we owe you $10,000, but the plumbing business is really bad and we're not going to be able to pay you. We are, in fact, going out of business. So what do we do first? Well, we could try to sue the Mario Brothers Plumbing for the money and spend $20,000 to $40,000 in legal fees to try to get that, but we might as well write it off. So they called us on April 23rd, and we've tried and tried and tried, and we finally said we're not going to be able to do it. So on the 23rd, we write off the $10,000 that the Mario Brothers said they can't pay. So how do we do that? Well, the transaction is the AFDA is debited for $10,000. Just for a moment, pretend there's money in there. Don't worry about anything else. And then we credit the AR for $10,000. Then we get a call from Mario, and he says, by the way, and it's like July, I just came into some money, and I feel really terrible that I did this. So I got a little bit of money, and I'm going to give you $4,000 of the $10,000 I owe you. I really feel badly. I'm willing to settle for the $4,000 I owe you. And here's a check. Ding, and I've got the check. Well, at this point in time, in July, and this was July 23rd, in July 23rd, when we got the check, we don't have an account for Mario Brothers anymore. But Mario said, here's $4,000, let's call it even, and walk away from this. So what we have to do is we have to reconstitute or reset up the account for Mario just for the $4,000, not for the whole 10. He didn't pay us 10, and we're not going to get the rest of it. He said, this is all I have. I'm not going to come back and give you any more money. And we've already written off the account, so we can't bring it all back, but we have to bring up some of it to account for the fact that he gave us $4,000. We just can't put it to an AR with nothing in it. This is AR Mario Brothers, a subledger. So first we have to do is we have to reconstitute the account as best as we can, and that's up to the $4,000. So what we do is we're going to reverse this and set up AR and the AFDA. We're going to reverse this, but only to the $4,000. That's all that he gave us. Now, we deposited the check, and we have to post an entry, do an entry, JE, for that deposit. And so we got cash, so we have to debit cash for $4,000, and it's paying off the Mario Brothers AR, their specific subledger. And are we in balance? Yes. Boom. And here's the key. Right here is that the $4,000 is being debited and credited. So that zeroes out the AR again. So AR is not affected. And because we actually collected cash, it's reflected in the fact that the AFDA has been refunded back up to where it was before we did this transaction, or at least to a point. We still have a $6,000 there, and that's how you would handle when a customer pays after having written it off. There's just a couple of other things I want to talk about in this chapter, and then we'll get to the next chapter. Again, this is chapter 9. One is called pledging receivables. when a business borrows money, you can attach any, not any asset, but most assets can be used to secure a loan from a bank. But most of the fixed assets were purchased already with a loan, so the money went to purchase those fixed assets. But what if a company needs some capital and they either aren't able to, or it's too soon, they may not be able to have the time to generate capital through a stock sale? Or if it's a partnership or an LLC, you can't sell stock in the market. They're not publicly traded, so people do not own stock outside the organization. There may be a small group who do. So if that's not the option, it's not a viable option to sell stock to the public because you're a more private company, then the only other thing is to borrow money from the bank. Well, to do that, you have to have an asset that is unencumbered. Well, unencumbered is a fancy word meaning that it's not security for some other loan. So if there's a property, if there's a plant, if there's some equipment, if it wasn't paid in cash entirely or there's no payable on it, then it's secure. If there's a payable, then that's the security. The equipment is securing the debt that is anticipated to be paid by the company. But we can take our accounts receivable and pledge them, meaning that if we don't pay the bill, they can take the receivables and instead. So that's cash money or anticipation of cash money. So that's what pledging receivables really are. And the bank goes through a similar process that we did in the balance sheet method to come up with a projected or a probability for when those payments will be made. The other thing we can talk about is what's called factoring. And I want to focus a little bit on factoring. Factoring is not a calculation. It's not an accounting thing, but it's a concept that we have, that's in business. What happens is, what if the company grants credit to a customer and the terms are net 30 days, no discount. All right? So the terms are 30 days, which means that the company, when they bill out anything to the customer has 30 days to pay them. The other side is that the company has to wait 30 days to get their cash. And the company has its own payables out there that they have to pay in either 30 days or less. So how can the company get from the customer the money any sooner? There's no incentive here to do that. They can offer a discount, but there's no true incentive to do that. Here's what can happen, though. What we do is we put in a factor in the middle. What the factor is you put the factor in the middle, and what happens is that the factor will pay money less a fee for the receivable, and the factor will expect the customer to pay in full. And what the factor will do is will be less than 30 days, usually 10 days, is when they will pay this money. And the factor will still wait 30 days for the customer to pay the factor. So what the factor has done is they've introduced themselves in the middle as a middle person between the company and the customer so that the company can get the cash faster. If they're getting it in 10 days less a fee that the factor guarantees will pay, then the company has no problem selling their receivable to the factor for the lower amount because they get it in 10 days versus waiting 30 days. Now the factor is going to wait 30 days for the money from the customer. Now it's written in factoring agreements that if the factor cannot collect the money, then the receivable gets pushed back to the company who's going to have to deal with it. The factor doesn't really take ownership of the receivable. They are the intermediary between the company and the customer in the payment process so that the company gets money faster, less a fee, and the customer still gets their 30 days. So they can sit and wait, but in the event that the customer doesn't pay the factor in 30 days, the factor will kick it back to the company most often and say, hey, we're not getting our money from the customer like you're supposed to. You granted the credit, not me. It's on you. You go and fight it out with them. And that's kind of how it works. In Chapter 12, we're going to talk about the book calls it non-current assets. I say fixed assets. It's about the same. It's the tangible assets that we acquire for the business. Machinery, buildings, vehicles, those type of stuff. So we need to know a few things, and the chapter's broken down into pretty much three main categories. There's how do we account for the acquisition of an asset, how do we account for while we own it, the depreciation of the asset. There's three, we're going to talk about three methods of depreciation, and then the disposal or the sale of a fixed asset. Now, an acquisition, that means when we get that's a fancy word for when we get a new asset. When we buy an asset, the original cost plus all installation costs is part of the book value, the original book value. Examples of installation costs are on page 417. And so just note that those are some of the costs involved in acquiring a. So the price may be $100,000, but if you spend $20,000 in delivering it to your shop and then adding a water line, an electrical line, to it, and it has to be vented, so you have to put some vents on the machine so that it vents out into the atmosphere outside versus building up carbon monoxide or other toxic gases inside the plant. All those things are part of it before you even switch it on. Any cost that you have to expend to bring the machine up to running order before you turn it on, up to running order, is part of this original cost. So not just the price that you paid, but furthermore, anything to bring that to the level that you need it to work. So if you buy a car secondhand that you're going to use as a delivery truck, and it was sold as is, so there's no guarantees or warranties on it, but it needed a new transmission. So you paid $1,000 for this truck that you're going to use, but you have to pay another $500 for a transmission because the transmission doesn't work. Well, that is a $1,500 truck now. You paid $1,000, but you had to put $500 of work into it to be up to the level that you could use it in your business. So again, 417 is some examples of acquisition costs in addition to acquiring the fixed asset. Now, depreciation, I said this before, is an accounting function that is a way of writing down the useful life of a fixed asset. Nothing lasts forever. We know that. And you can't take it with you. You know that one too. But nothing lasts forever. And in accounting, we have to account for the fact that fixed assets have a time. Now, the useful life is not something absolutely arbitrary. GAAP and FASB have come up with categories or classes of assets that fit in with different years. There's a 3-year, 5-year, 7-year, 10-year, 20-year, and I think 30-year class of depreciation. So those are the times that would be considered useful life. Most assets that businesses have are 5 years. So that's why we tend to use a 5-year pattern, but there is no absolute written in stone. GAAP has many stone, they think they're written in stone. And we have 3 main ways of depreciating. There's the straight line method, the double declining balance method, and the units of production method. We'll go through, I'll give you an example of all 3 in a little bit. And the third part of this chapter is the disposal of the asset. Now that you are done using it and it's in still good order, get rid of it. Well, what is that really called? That's called a sale of a fixed asset or a non-current asset. And we're going to show JEs in accounting for the fact that if we sell it above what we paid or below what we paid, that's a gain or a loss on that asset. Gain or loss on the sale of the asset. Now, there is a little bit of another piece that you need to know. And it's quite important that you know this. That there is a difference between betterment and extraordinary repairs and mere maintenance. If we go back to that truck that you bought for $1,000, and you put in we put in a new transmission, so now the book value is $1,500. So that's the price that we paid with all costs involved, $1,500 for that truck. Now, you do an oil change on that truck. Did that have anything to do with its value? Did it change the value of that truck in the marketplace? No. Did it make it last longer? An oil change will make it last a little bit longer, but it's a marginal amount. If you don't change the oil, its life will decrease quite a bit. But an oil change is really a maintenance. It maintains its life. So it's considered part of its useful life, and that's a maintenance. And an extraordinary repair, so that oil change was called a maintenance, not a betterment or an extraordinary repair. If 2 years from now we put in a brand new engine, and it was not just a brand new engine, we changed it from a diesel engine to a natural gas engine. That changes its value quite a bit because it's a more valuable car because it's cheaper to run. Natural gas, at one point, there were cars that were running on natural gas. That was maybe 10 years ago or so. Natural gas was a cheaper alternative to crude oil or petroleum or car gas. So natural gas car at that time would have been considered a betterment by replacing the engine with a natural gas engine, and that would have increased its value. On the other hand, after 2 years, now this is a 10-year-old car, but because we just got it, it resets its useful life, probably 3 years versus 5. Well, let's go with 5. And we now replace the engine completely. The entire engine we replace after 2 years. It had nothing to do with the transmission. We just felt that we needed a new engine. That actually will change its useful life because the engine is what drives the car, not anything else. I mean, there's the drivetrain and there's the transmission, but if without an engine, the transmission is nothing. And without the engine, there's the drivetrain means nothing. The chassis means nothing. So because that would be considered an extraordinary repair. So you got to think about, what did we do with that asset? Was it something that made it improve the asset? That means the book value would increase. And so the cost of that is capitalized, which means it's part of it changes the book value, and then it's depreciated from there. It's got we redo the depreciation for the remaining life, and it depreciates from there. An extraordinary repair increases its useful life, And because the useful life is increased, then we depreciate longer. So it's no longer will last 5 years, it may last 2 or 3 more years. And maintenance is just an expense. So a betterment or an extraordinary repair affects the value on the asset. Maintenance is merely an expense, and it does not affect the value. Acquiring an asset is either you're paying cash for it, or you're paying it through a payable, whether it's a note payable for a long term or an accounts payable or short-term note. And it's simply, remember that we're talking about assets, so we're increasing the assets. So if we buy a piece of equipment on account, it would be some sort of payable, like an accounts payable. Usually accounts payables for trade payables, your day-to-day, and it wouldn't be used for this. I most likely would see it as a note or a note payable because you're going to take a long time to pay it. So there's probably a note payable versus an accounts payable for $100,000. And remember that this $100,000 is not just the price we paid, it includes all installation costs or any cost necessary to bring it up to a working order that we can use it. Now, sometimes when you buy an asset like a building with a parking lot, like an office building, and you buy that, then you're also buying the land underneath the building itself, and the parking lot. So we need to account because sometimes each of these items have different useful lives. Generally, in this class we're not going to, but land is considered, does not get depreciated. So there's no depreciation on land, but building in a parking lot probably does. You know, that parking lot doesn't last forever. Take a look outside your parking lot and look at the state of that parking lot, and then tell me that parking lot's last forever. You can tell me a lot about the building that you're in. I can get it. You'll give me an earful of how great your building is with the repairs that you get from the MDOC. So we paid, in this example, we paid $800,000 for this building and parking lot. But we have to create 3 separate accounts because with the building came a parking lot and the land underneath. And we could raise the building and the parking lot and still have the land for something else and sell that separately. And again, the building would have to have its own maintenance. There could be some betterment or some extraordinary repairs to it that will change its value. And that would be independent from any value change to the land, which probably wouldn't change. So what we did was after we bought it, or as we were buying the land, this office building with a parking lot, we had it appraised. And most likely because the bank wouldn't give us the money unless there was an appraised value and determine how much we're actually going to pay for it. Now, we got the loan for $800,000, but the appraiser appraised each one of these separately as separate items. And we combine it into one top value. So the land was valued at $600,000 by itself. The building by itself on the land is $300,000. The parking lot is $100,000, which gives us a total of $1 million. Appraised value. That is not the value we put into the books. That's the appraised value. So how do we determine how much of this $800,000 we put in the land GL, we put in the building GL, and we put in the parking lot GL? Well, we take the percent of the value. So if it's $600,000, what percent of the appraised value of $1 million is $600,000? 60%. And 30% for 300 and 10% for 100. So we can say that the parking lot is worth $80,000. The building is $240,000. And the land is book value, $480,000. What I did was I took 60% of 800, 30% of 800, and 10% of 800. That's 6, 7, 8, 800,000. Yes. And that's how you would attribute the price, because we paid only $800,000. So when we write out the GL for the transaction for this, we would say we would debit land. Let me draw a line so you can see that. You debit land, building, and parking lot. We'll debit it for 480, the land for 240, and the parking lot for 80. And we paid cash. Let's pretend we paid cash of 800,000. And are we in balance? Yes. Boom. Now let's talk about the three main ways of depreciating. Remember, depreciation is the accounting way of writing down an asset. Here we have some basic information about an asset. We have an asset, let's pretend it's a truck, that we originally paid with all installation $11,000. Now, it's got a 5-year useful life, and at the end of 5 years, it's going to have a book value of $1,000 net. And so we're going to talk about the straight line, SL for straight line, DD for W to declining, and the unit of production. It uses in its life, on average, it normally lasts about 200,000 units. It could be driven, we could use miles for the units. So we can drive it in 5 years, we can drive it 200,000 miles. And this is the number of miles that we've driven each year that we've had it for the 5 years. So straight line, the straight line method works like this. You take the value minus what I call salvage, or the residual value, which is 1,000, and divide that by the number of years of useful life. So if we use this, it's 11,000 minus 1,000 over 5 gives us 10,000 divided by 5 gives us 2,000. And that's our depreciation expense each year, 2,000. With straight line, the thing is that the depreciation expense is fixed. It doesn't change year after year. So let's do it. And I've got little charts here going on. So we're going to try to write big. So we start off with a value of 11,000. Our depreciation expense is 2,000. That means our accumulated depreciation is 2,000. We've only accumulated 1 year. So 11,000 minus 2 is 9,000. This goes to the next year. So this ending balance is the beginning balance of the following year. Our depreciation expense does not change. Our accumulated depreciation does, because we've added 1 more year of depreciation. 9,000 minus 2,000 is 7,000. And that gets to our third year. So that's year 3. 2,000 is still the fixed depreciation expense, and our accumulated depreciation adds one more, so that becomes 6,000, and 7,000 minus 2,000 is 5,000. That 5,000 is then now year 4. We still have 2,000 of depreciation. We have accumulated depreciation of one more year, so our accumulated depreciation grows to 8,000. And 5,000 minus 2,000 is 3,000. Now we're in our 5th year. The depreciation expense is still 2,000. We add 2,000 to 8,000 becomes 10,000. 3,000 minus 2,000 is 1,000. And here we are. There is our residual value at the last year. That's what we wanted. And now we have our depreciation schedule. We know exactly how much we're going to depreciate every year, and we know how much accumulated depreciation, and this ending balance is really the ending net book value, because depreciation expense is an expense, but accumulated depreciation, or ACDEP, which I call ACDEP, accumulated depreciation is a contra account to your fixed asset. Each fixed asset has a accumulated depreciation to reduce it. So this is its net book value each year, and the net book value will be 1,000. We paid 11,000. We have 1,000 left over. Now, in straight line, the depreciation expense doesn't change. That's that straight line part of it. It doesn't change. With double declining, what we do is we take the percent that represents the number of years, which in this case it's 5 years, so that is the same as 20%, and we double that. So double declining says that we're going to take 40% of the value as the depreciation expense. So what we do is we take the value and we take 40% of this ending balance, or the beginning of the period balance, for the depreciation expense. Again, with straight line, we have a flat, even expense. With double declining, the depreciation expense starts out large and gets smaller and smaller, as you can see. That means that we front end more depreciation in our early stages and less at the end stages. What's steady in straight line, the depreciation doesn't change. The depreciation expense amount doesn't change. In double declining, the percent doesn't change, but the depreciation expense amount does. So we start off with 11,000. 40% of that is 4,400, and that's our accumulated depreciation. 11,000 minus 4,400 equals 6,600. That carries down to year 2. Year 2, 44% of 66 is 2,640, which gives us an accumulated depreciation of 7,040, and our ending balance is 3,960. 1,584 is our 3rd year depreciation expense, which brings our accumulated depreciation of 8,624, and the net balance of the asset of the truck at the end of the 3rd year is 2,376. 950 and 40 cents is the 40%, or the depreciation expense of 2,376. 95.74 and 40 cents is the accumulated depreciation year 4, and the net fixed asset, or the net truck, is 14.25 and 60 cents. Now here is where it gets a little wonky. We have to make sure that we have $1,000 of an ending balance, a residual value, at the end of 5 years. So it has to be equal to 1,000, and the accumulated depreciation must be 10,000, just like it was here. These last 2 cells in this chart will be exactly the same between the straight line and the double declining. It will always be, because we have to have that residual value whether you use straight line or double declining. So what happens is the depreciation expense is not multiplied by 40%. I mean, this balance is not multiplied by 40%. We need to make sure that the end, when we subtract out the depreciation expense, equals $1,000. So that is not a 40% of that. That is the last bit of depreciation we must expense to bring the balance or the net fixed asset down to 1,000. Now with units of production it works a little differently. Units of production, what we have to do is we need to know how much is each unit's value. What is each of these units in dollar value? This is not the dollar value. This is the amount of units. So in units of production, we ignore the salvage. It doesn't work. It can't work because we have a projected or predictable based on the manufacturer how many units this truck will work or how many units this piece of equipment will run. And that is based on the manufacturer, not through actual experience. They don't run it through and say, we're going to call it brand new, but we just ran it for 200 units, and now we know it will last 200 units, so that should be how much you're going to get. Actual and projected or predicted values are not going to be the same all the time. It's projected to be 200,000 units. Well, how many dollars does 200 units really count of the value? So in units of production, we ignore the salvage value. It doesn't mean anything. So with units of production, we actually need to find out how much that unit, what is the dollar value of each unit. And so we have to take 11,000 minus 1,000, because that's our residual value, and divide that by 200,000 units. So that's 10,000 divided by 200,000. That gives us, so what we do is we take that 5 cents, because that's the price of the depreciation per unit, and we multiply it by the number of units of usage on that truck. So I did that here, 30,000 times a nickel, 25,000 times a nickel, 35,000 times a nickel, 55,000 times a nickel, and 45,000 times a nickel. And it's the same. Once you put in the depreciation, you do the same thing over and over again. Notice, though, in units of production, even though we've calculated the units of production based on with the residual value, we still have a residual value that's greater than what we were expecting. And that's because the units of production is inconsistent. It's more accurate in the fact that it actually determines how much of the fixed assets being used, and that is how it's reducing in value. And because of its usefulness is not through the life of the asset, it's through the use of the asset. And that's why it's a little more accurate, but only works with any type of machinery that you can actually show a usage. A building, you can't see how that's being used, so how do you depreciate using in units of production, because a building doesn't produce anything? It works with something that has a production aspect to it, like a car or a delivery truck. You drive the delivery truck. It is part of the production line. It's the end result, taking your finished goods, your products, and delivering it someplace. That's a delivery, and the truck is used for that. So that truck uses up mileage, and so you can measure the mileage. So that's one way we could use this, and this is a delivery truck, so we're talking about the number of miles that was driven in those individual years. So that is how the three main ways, the comparison between the three different methods of depreciation. Now, which one is better? Well, it does depend. Like I said, units of production can be considered better if it was in conjunction with an item that can be easily quantified as far as a unit of how many units it can produce. If it's not quantifiable, it doesn't work. The double declining depreciation, the double declining balance method with the percentage that's double what it would be on a straight line is fine if you're trying to front end or increase the amount of depreciation. You want to depreciate early and more early. That would be if you wanted to plan on maybe selling this product or this truck or fixed asset in after 2 or 3 years, where the book value is lower, so you could it still retains much of its market value. In a couple of years, it won't have depreciated too much, and you might be able to get a little bit more revenue or money from that sale. The gain on that might be larger. That's a possibility. Straight line happens to be the easiest method because you just take the value or the price minus the residual value or salvage value divided by the number of years, and boom, you've got your depreciation expense. And it's the same every year. Okay, let's finish this chapter off with disposition or disposal of an asset. I'm going to take this right out of the homework book. This particular problem is in the B section, so you will have the answers, but I'll give them to you right now, so you don't have to look for them. It will be available to you with this answer, but I'm going to do it with you. What we know in this particular situation is that the price we paid for a machine, this particular machine in October of 2017, doesn't matter when in October, we'll just take the whole month of October. In October of 2017, we bought a machine for $40,000, but it cost $5,000 to deliver it to us, and it cost $7,000 to install it. And remember that the entire cost of purchasing a fixed asset is not just the price we paid for it, but it also includes delivery to our facility and any cost to get it set up. Any legal cost, any hookup cost, those are all part of the original cost or the original book value before we start depreciating it. So the first question is, what is the original cost? The first question is, so the answer is, if you take 40 plus 5 plus 7, that gives us 52. We sold this machine in December, at the end of 2018, at the end. And let's just assume then that we purchased this machine in October 1st of 2017. So it's the first week of October, near the first of the month. We purchased it, and we're going to sell it at the end of December of 2018. So, what is the book value of this machine at the end of December? And then we can do the JEs and to show the disposition or disposal of it. So, it's 8 years, and I will tell you, it says it in the problem, but I'll tell you it's straight line 8 years. So how do we figure out our annual depreciation expense? Well, remember that we take and we'll assume that, and to calculate this, there is no salvage value. So we don't have to subtract anything. So we take the 52 and divide it by 8 years to get our annual depreciation amount, and then we take that depreciation and divide it by 12. So that will give us an annual depreciation amount of, so 52,000 divided by 8 comes to 6,500 per year, but we need a monthly rate because we're looking at not exactly 1 year, but it's more than 1 year. So that's 542 per month is our depreciation expense. Now, how much accumulated depreciation do we have? That's the next step to figure out what is our net book value at the end of 2018. Well, we have October, November, December. We have 3 months. So we take 542 times 3, which will give us 1625 approximately. We'll just make it approximate. And then we have 542 for 12 months, and that'll give us about $6,500. We add those together, 6, 7, 8, 81, 25. So that's the total amount of accumulated depreciation we have. So our original cost is $52,000. We have $8,125. So what is our ending end of the year book value, which is the net of the cost minus accumulated depreciation, which gives us our net book value of $43,875. Now, we sold it for $40,000, and our book value is $43,875. So do we make money or do we lose money? If we sold it at that, and we sold it at 40, and it was on our books, the value is over 43,000. We lost money. So what does the JE look like for that? So we sold it at 12/31 of 18, and we received $40,000 for it. So that's the cash. We got cash of 40. That's our debit. What we have to do first is we have to get rid of our we have to get rid of it. We have to write it off, not write it off, but we have to erase it from the books. So we start off, we go all the way back to the original cost to start this off. So our original cost is $52,000. That's a debit because a fixed asset, and since it's an asset, it's a debit balance, that 52, the original 52. So we have to reverse that. When we are getting rid of an asset, we have to reverse that. So the reversal is we have to credit the fixed asset, or we're going to call it equipment, or we'll call it machine, for $52,000. Now remember that accumulated depreciation is a contra account, so it's opposite. So it has, this is a credit balance, $8,125 is a credit balance. So we have to debit that to reverse that out. We need to clean that out. So I'm going to put that on top here so we can keep our debits together. So I'm going to put ACDEB here. And that's $81.25. $81.25. And we're in balance. We have $48,125 on the left, $52,000 on the right, and we're now in balance. Are we in balance? No, we're not in balance. We are missing something. We're missing the fact that our book value, which is the original cost and the accumulated depreciation, less the accumulated depreciation, is more than that. So because we sold it for more than our book value, we have a loss. And when we lose something, when there's a loss, it's sort of like an expense. We have to debit it. So we have to put another debit on this side. How much? So we have 48. If we add these together, it's 48,125. We need to get to 52. So that's 3,875. And that would be a loss on sale of machine. What if the book value is actually less not more. Let's pretend that the book value is 30,000. So I'm just changing things here. This is 30,000, not 43,000. We still sell it for 40,000. So that makes our accumulated depreciation 22,000. And the original cost is 52. And we're still selling it for 40. What will the JEs look like then? Well, we start off still with 12, 31, 18. We still got cash, so we still put the cash in here of 40,000. We still have to debit the accumulated depreciation to get rid of this credit balance, so ACDEP is going to be in there. For 22. And we still have to reverse the machine. With a credit of 52. Are we in balance? No. We have 62,000 on the left and 52,000 on the right. So we're off by 10,000. Where is that going to go? That actually is going to be on this side. It's a credit, and that is gain on sale of machine. And that's how we would account for in two different scenarios, when we sell it at a loss or sell it at a gain over what we paid for it, or gain over the book value. And it's based on this book value here that we're looking at. In the original problem, it's 43,875. In my second scenario that I came up with, it's 30,000. One is over the price. How much we're selling it for is under book. The other, it's over book. So if it's under book, that's a loss. Over book, it's a gain. If it's a gain, we're actually gain on a sale of machine is considered income. It's not regular income, it's not revenue, but it's an income. And this will be, actually, it would be, we would have to pay tax on it. The tax in this case would be capital gains. Or, I'm sorry, this would be an income tax, not capital gains. This would be actually a credit or a reduction in our income because the loss would be treated like an expense. It's not an expense. We didn't spend the money. We just didn't get as much money. So it's treated as an expense on the income statement, this loss, and that will, so it sort of reduces our tax liability. So it's kind of like a tax credit. The last thing I want to talk about in this video is a little bit about Chapter 13 and current liabilities. Current liabilities, and more specifically, are short-term notes, notes that have terms of a year or less. And again, a little more specific is the fact that if the note, the due date is beyond the fiscal period and is well into another period, so it's not due till another fiscal period, then we're not going to pay it. But we have to account for the fact that we owe the money and we owe interest. So we're talking about what's called a single pay note, a note that's paid once. You don't have to make payments on it, but we have to show that we have accrued interest. So this is an accrual on the current liability side. And what we're going to talk about is interest payable. So I have a scenario here. We borrowed money, a $600,000 loan that is 12% interest. And remember, when interest is stated, it's always an annual interest rate. So we have 12% per year, but the term of the note is only 6 months. Now, our fiscal year ends on June 30th, not December 31st. So it's not considered a calendar. Fiscal year is not the same as calendar year in this case. Normally it is, Normally it is, but in this case it isn't. And the note date, the date we borrowed the money, was April 1st. So if we count 6 months from April 1st, that would be through April, May, June, July, August, September. So at the end of September, or October 1st, is the due date. So we have to pay it in October. Now, June is in the middle of that. So on June 30th, we have accrued interest. How much interest did we accrue? So the first thing we need to do is show what is the JE on April 1st when we got the money. So 4-1, we got, if we borrow money, we got cash. So we say cash is a debit, and we credit notes payable because we owe it. And it's a short term, so we'll keep this in the current liability section, and that would be $600,000. Now on June 30th, we have to do an adjusting entry to show that we've accrued interest. We've accrued April, May, and June. We've accrued 3 of 6 months of interest. How do we accrue that? How do we show that? So, and we don't have to do this monthly, we have to do it just at the period because we have to show the accrual of interest that we haven't paid. We don't have to show that we accrued April interest, May interest, and June. We can do it all at once. It's not necessary because we don't owe it, but we can do it. So, how much interest do we have? We have 3 months at 12% per year. So how much is that per month? That's 1%. So 1% of 600,000 is 6,000. Times 3 is $18,000. So we would expense it but since we're not paying it, it's payable, we have to create an interest payable account for the 18,000. Now, on October 1st, we're going to pay the loan off. We're done. So October 1st comes around, it's time to pay it. We're going to debit notes payable to get rid of the note. That's 600,000. Okay. Now we're going to pay this payable, so we're going to debit the interest payable for 18,000. But we've also accrued another 3 months. So we have another interest expense. And we have to pay it in cash, so we're going to credit cash for $636,000. Why? Here's the first 3 months of interest that we accrued. This is the second 3 months of interest we accrued, but now it's time to pay it. So we don't have to hit the payables a second time to make an extra step. We just expense it at this point. And if you think about it, if we had 12 months of interest, half of that 6 months. So the total amount of interest we should be paying is $36,000. 6% of $600,000. That would be $636,000 total. Another thing that we talk about in this chapter is warranties. And this is warranties offered. It's the same as that extended warranty you get with your car, or you buy when you go to Best Buy and you buy an appliance and say, hey, you want to buy a service contract before you leave. You really want to get that because
the manufacturer's warranty is only 1 year, so you can get a 5-year plan, and then you'll be protected for another 5 years after the manufacturer's warranty. Blah 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 blah. That's all they're trying to upsell you. But if you do buy it, how do they account for the fact that they owe you a service, the service on that appliance? So, and if they sell it to more than one person, they have to keep this bucket of money that you've paid in some place. It's called a warranty payable, or an estimated warranty liability. Estimated warranty liability. So we have to set this account up once we collect the money in anticipation of, and put it aside so we can pay for those repairs when you bring that appliance back in. In this particular problem I'm giving you an example of, we're talking about sunglasses. And this company sells sunglasses and sells a $10 warranty on top of the sunglasses. You pay $10, we'll cover you. And so in this particular case, they offer a $10 per pair warranty, and they sold 400 pair. So first, we need to account for the fact that we owe somebody, not the customer who paid it, but we owe the money to be paid for the repairs, because we are obligated through the fact that we either get paid for this outright, or we offer a free warranty, but we have to have that money somewhere. And we estimate that we need $10 per pair. So here's what happens. Let's pretend that we sold these by the 31st. Okay? Let's just pretend that. And so 10 pairs of $400 is $4,000. So we have to debit warranty expense for $4,000 and credit estimated warranty liability for $4,000 in anticipation of what we need it for. Now, in addition, part 2 says that we have found that in the year we actually spend $200 in inventory parts to fix sunglasses, and we've spent $100 in cash to pay for third parties to come in and help us fix these. So we had the parts, but we didn't have the people to do it. So we had to pay extra for people to come in and fix these sunglasses throughout the year that were returned. And returned because they are returned for warranty work. So, how do we account for that? Well, we have the money here in this account, the $4,000 right here. So we debit the warranty liability. We debit it for $300. That's the total amount we spent. We're going to credit parts inventory. Which is an asset, and we're going to credit cash because we spent the cash. So parts inventory is going to be debited or lowered. It's reduced by $200, and cash is reduced by $100. Are we still in balance? I said, are we in balance? Yes. Boom!